actually, I should have made this the first slide. The actual title of the bill, H.R. 1479, or the Community Reinvestment Modernization Act of 2009. There is information on our website, ncrc.org, that has a lot of detailed information about both CRA and this bill. And it's on the upper right-hand side of our webpage. We call it the CRA Toolbox. And if you don't see it, kindly contact us, and we can make sure that you have it.
Should I tell them who to contact? Should they contact?
They can contact a number of us. There's Sarah Betty in our membership department, also Marcia West, also myself, Josh Silver, and there's other staff as well that can be contacted.
I'm going to list their emails.
And there is also, if you want to know who has co-sponsored this bill, our webpage also has a list of the current co-sponsors. The bill was introduced in Congress by Eddie Benice Johnson, Representative Eddie Benice Johnson of Dallas, Texas, and also Luis Gutierrez of Chicago, Illinois. And right now we have 37 co-sponsors. And what we are trying to do is the more co-sponsors we can get on this bill, the more likely it is that this bill will move through the House of Representatives and then on to the Senate. So right now it is very important to demonstrate visible support for the bill by trying to get as many co-sponsors on the bill as possible. So the bill does three major things. It strengthens CRA as applied to banks. It enhances data disclosure. And it also applies CRA to a wide range of non-bank financial institutions. So let's go to the slide that says CRA serving communities responsibly. And I'll wait, OK. We talked before about how CRA has succeeded in making sure that banks serve communities safely and soundly with their lending activities. And we talked about the 6% figure previously, so I don't have to repeat that the 6% figure. But that's very important. If CRA did not serve communities safely and soundly, we would basically have no basis for updating and expanding the law. We go to the next slide. Now we know that there is a wide variety of financial institutions that were not engaged in safe and sound service to their communities. We know that there was a lot of risky lending going on. There was a housing boom in the country the last several years. And in an effort to compete, the lenders started to lower their underwriting standards, and it was a downward spiral to riskier and riskier forms of lending. And remember that the great majority of this lending was done by mortgage companies that were not covered by the Community Reinvestment Act. And this lending was financed by Wall Street investment firms that were also not covered by the Community Reinvestment Act. And we talk about, in the public discourse, there's discussion of $700 billion of a bailout of the financial industry, or TARP, the Troubled Assets Relief Program. What's not known is TARP is actually the tip of the iceberg. When you total up all the loans, investments, and subsidies that have gone to prop up the financial industry, we are talking about $12.8 trillion. Basically $12.8 trillion of taxpayer money that has gone to bail out the financial industry and to prop them up. And isn't it a terrible shame that if we had had the Community Reinvestment Act applied broadly throughout the financial industry, CRA says serve communities consistent with safety and soundness. NCRC believes that we would not be in this mess, or at the very least, the magnitude of the crisis would be much less. Because again, it's a requirement to serve communities consistent with safety and soundness. So we know the federal government has taken extraordinary steps to provide a safety net for the financial industry, and they will likely provide a safety net for the financial industry in the future. Therefore, doesn't the financial industry have an obligation to serve society, and particularly communities that have been historically discriminated against, particularly low and moderate income communities and minority communities? Again, the case is made that CRA should be applied broadly throughout the financial industry. So we go to the next slide. We're going to talk first about how the Community Reinvestment Modernization Act of 2009, or H.R. 1479, would strengthen CRA as applied to banks. Before, in the CRA 101 part of the training, we talked again and again about how CRA grades banks on serving low and moderate income individuals and low and moderate income communities. You notice I did not say during the first part of the presentation serving minorities. The law was originally written to say serving low and moderate income individuals and communities. We think it is time to say that CRA exams should also explicitly examine lending, investing, and services to minority communities. Last week, NCRC released a report called Assessing the Double Burden, examining lending by race and by gender. And it's on our webpage, ncrc.org. And it is a third report we've done. We've done a series of reports that say income is no shield against racial disparities in lending. And what these reports document is what a lot of other people have documented, that minorities disproportionately received the risky lending. And it doesn't matter whether you're a low and moderate income minority or a middle and upper income minority, you're almost equally likely to receive the high risk lending. I could do a whole other presentation about the findings of this report, but suffice it to say, our report shows the racial disparities in lending by every single metropolitan area, and it shows it by low and moderate income minorities compared to low and moderate income whites, and middle and upper income minorities compared to middle and upper income whites. And we think that if CRA had looked at lending specifically to minorities, that banks actually would work a little harder in serving minorities with prime loans. Remember, banks are traditionally prime lenders. We've actually done some research, and others have done research, that shows that banks' record actually reaching low and moderate income borrowers is a little bit better than their record of reaching minority borrowers in communities. Whether you're looking at loans or bank branches, for example. And one reason why we think that this has been the observation is that CRA applies in examining bank lending and service to low and moderate income people, but does not apply in examining service to minorities. Again, think of your student and think of a report card. If your report card grades English but does not grade math, you're more likely to do better in English than you are in math. So it's a simple concept, but I think a very profound concept, that just like you should have a report card for English and math, you should have a report card if you're a bank for serving low and moderate income people and serving minorities, including, especially since there is such a wide research. NCRC, Federal Reserve Board, academics, other community organizations have documented these stubborn and persistent disparities in lending over the years. And we go to the next slide. Update CRA assessment area procedures. Assessment areas. That's actually regulatory jargon for saying, what are the geographical areas on CRA exams? The geographical areas on CRA exams are areas where bank branches are located. And remember, CRA was enacted in 1977, and in 1977, banks made loans through their branches. They collected deposits from the community, and they made loans through their branches. Today, the financial industry is very different, and banks make loans through brokers and through over the internet, through correspondence, and through other non-branch mechanisms. So if the financial industry and banking has changed over the years, it is time for CRA exams to also change. And so CRA exams still largely examine banks where they have, in the geographical areas where they have branches. But for a lot of banks, there is a lot of geographical areas where they lend through brokers. And it's time to make sure that the CRA exams include the geographical areas where they're making loans through brokers. And in fact, the Federal Reserve has done research that has shown that there is less likely to be high-cost lending by the bank in areas served by their branches than in areas where they're making loans through brokers. So even within CRA, the fact that there's incomplete coverage, shouldn't we make sure that bank lending is uniformly safe wherever it's lending? So let's expand CRA exams to the geographical areas where they're lending through brokers and other non-branch means. And the CRA Modernization Act would do that. Go to the next slide. Mandatory inclusion of bank affiliates. Bank affiliates, what does that mean? That's a fancy word for saying, actually banks are organized into holding companies. And a holding company may own a bank, and it may also own a mortgage company. Right now, CRA automatically includes banks on their CRA exams, but does not include mortgage companies automatically on CRA exams. It's at the option of the bank whether the bank wants the mortgage company affiliate on its CRA exam. And again, if you're a student and you say, okay, maybe I'm not so, I'm good in Spanish, I'm good in math, I'm not so great in PE, so I don't put PE on my CRA exam. So there has been instances documented by NCRC where mortgage companies are engaging in disparities by price in lending, or not making loans to row houses or other forms of redlining. And we found that it was these affiliates that were not included on their CRA exams. It's less likely that they would be engaging in this type of discriminatory and redlining behavior if they were included on their CRA exams. So we say eliminate the option of whether this mortgage company would be included on the CRA exam and make it mandatory that the mortgage company is automatically included on the CRA exam. And that's what the CRA Modernization Act would do. We go to the next slide, enhanced data disclosure. John Taylor, President and CEO of NCRC, says that data drives the movement for economic justice. And what that means is if you have data on a bank lending activity, you have more insights into whether the bank is serving all segments of the population fairly and equitably than if you don't have data on bank performance. And it is amazing that the activists in the 60s and 70s were as effective as they were because they didn't have publicly available data on bank lending by race, by gender, by income. They had to generate reports through experiences of neighbors. And it is much harder through anecdotes and recording experience of neighbors to document a systematic pattern of either service or not service to minorities and low and moderate income people. It is much easier to assess patterns in lending if you have data. The Home Mortgage Disclosure Act was enacted in 1975 to include data by race, to include data on lending. And initially it was by neighborhood, but then it was amended to include data by race and gender and income of the borrower. And this has been very powerful. If you have this publicly available data, anyone can look at it. And whether it's a governor of a state, whether it is an elected official, whether it is a newspaper, whether it's a community organization. So the public debate and discussion with this publicly available data did increase responsible lending to low and moderate income people and minorities over the years. Couple that with CRA exams. But then we reached a time period where you had a lot of risky lending. And this is where the data started lagging. The data did not include information on loan terms and conditions. It did not include information on really how much in debt were the borrowers. There is an underwriting technique in banking, the debt-to-income ratio. How much debt relative to your income? It's really dangerous to make loans when the debt exceeds 50% of somebody's monthly income. And if you had this information publicly available, you could detect lending that really got borrowers into serious debt before it became widespread industry practice. The CRA Modernization Act would include debt-to-income ratio, loan-to-value ratio. Another type of risky lending was lending that started somebody at a low rate, a teaser rate it was called, but then the rate increased dramatically over succeeding years. This was a type of adjustable rate mortgage lending. it would be nice to know whether a loan was a fixed rate loan or adjustable rate mortgage loan. That type of data disclosure would also be added by the CRA Modernization Act. And we'd have information on the creditworthiness of borrowers. It would be very useful for regulators, for people in the general public, to have data on borrower creditworthiness to know if similarly situated borrowers were getting very different prices or very different loan terms and conditions. And imagine if we had this type of data over the time period 2003 to 2007. 2003 to 2007 was the worst years in terms of the risky lending. If we had this enhanced data on home lending during that time period, there would have been discussions a lot earlier, debate in Congress, discussions in the newspaper, and I think this highly risky lending would have been curtailed much sooner, because people would say, whoa, it is really not a good idea for a lot of the lending to be above 50% debt-to-income ratio, for example. This is not the only enhancement to the data disclosure by the CRA Modernization Act. I talked earlier about the CRA small business data. The CRA small business data is less detailed than the Home Mortgage Disclosure Act data. The CRA small business data basically tells you the neighborhood that the loan is made in, but it does not tell you the race and gender of the small business owner. And one of the things that the CRA Modernization Act would do would enhance the data disclosure to include the race and gender of the small business owner. So for those of you who serve women and minority-owned small businesses, you would now be able to find, if the CRA Modernization Act passes, how well the banks in your community are doing in terms of serving women and minority-owned small businesses. And just like this information increased responsible lending in the home mortgage arena, we believe that this would dramatically increase responsible lending in small businesses. John Taylor tells me often how many times he gets, how many times he's in conversation with women or minority-owned small businesses that just have still terrible stories of not being able to get loans. In this foreclosure crisis, wouldn't it be nice to have a national data set on where the loans of neighborhoods that the loans are delinquent, default, or in foreclosure, and whether the loans are being modified? The CRA Modernization Act would require the Federal Reserve Board to establish a national database that shows foreclosures and loan modifications. Let me stop there. I have said a lot, and let me see if there are any questions. Guess not.
I have
Okay.
one online, but
well,
I mean,
let me talk a little bit more, because there is such a huge dimension to this bill. Remember, the three basic components of the bill are applying CRA, strengthening CRAs applied to banks, data disclosure enhancements, which I just talked about, and applying CRA to non-bank financial institutions. And Ada, my colleague, asked me, is there a real understanding of how profound this bill is? And one way to grasp how profound this bill is if you think that the last 30 years we've had about $6 trillion of loans and investments done by banks in low-income and minority communities. Think about if we're successful in applying CRA to a lot of non-bank financial institutions, insurance companies, securities firms, mainstream credit unions. We would not be talking about $6 trillion over the next 30 years. We may not be even talking about $12 trillion. It could be an exponential increase in lending and investing in minority and low moderate income communities. But not just an exponential increase in lending, an exponential increase in safe and sound lending. And also think about how we have a foreclosure crisis the likes we have not seen in 70 years since the Great Depression. I think what's also very profound about this bill is if we had CRA expanded broadly throughout the financial industry, we may not have this foreclosure crisis. And we know that this foreclosure crisis has cost about $13 trillion of loss in home wealth and home equity. $13 trillion, that's according to the Federal Reserve Board. And if we had had CRA applied broadly throughout the financial industry, we wouldn't have this loss. And we wouldn't have millions of people losing their homes. And we also believe that this foreclosure crisis is the greatest wealth loss in minority communities perhaps ever. And again, we probably wouldn't have had that if we had had the CRA modernization bill. There's a question.
Yes, let me see. What you just said indicates that there is no data. CRA Mod is trying to add racial data to CRA. So that accusation is completely without merit.
The question in the room is, how can you say that CRA caused a crisis if you really had incomplete data to document what type of lending was going on? So let me backtrack for a second and say what we do know, and what the Federal Reserve did, is it had data on whether a loan was a high-cost loan or a prime loan. Mm-hmm. So that's where you get that 6% figure, that right. Banks, only 6% of the high-cost loans were made by banks and considered were made by banks to low and moderate income people and considered on CRA exams. So that's how you have that data. What the Fed also did is it looked at the performance of, it had to combine the Home Mortgage Disclosure Act data with some proprietary data to look at the performance of subprime loans in low and moderate income neighborhoods compared to middle and upper income neighborhoods. And long story short, is the high-cost loans perform similarly in both low-income neighborhoods and upper-income neighborhoods. If the high-cost loans perform a lot worse in low-income neighborhoods, you could say, well, maybe it's the lending to low-income neighborhoods, but the high-cost loans perform about the same. So that also casts doubt on the theory. But that's exactly right, because you don't know the debt-to-income ratio, the borrower credit worthiness, the loan-to-value ratio. You really lack critical pieces of information that really could have been early warning systems to have stopped the crisis in its tracks, and to really know what type of lenders were doing what.
Can I give two questions?
Sure.
These are from online. The database of loans. Would this be reported annually by?
You would need to get the data from the servicers, and actually, this aspect of CRA modernization was modeled after proprietary databases that we know exist. And the proprietary databases, they collect data from servicers. So
annually?
It is annual, so it would be an annual database.
Okay, there's one more question. Claiming that there are small
Well, we've actually done some research, and the question is about CRA and credit unions, and how, would CRA be a burdensome requirement on the credit unions? Credit unions are small. NCRC has done research on the credit union question, and first of all, there are some very large credit unions. Navy Federal Credit Union, for example, has $38 billion in assets and 3.25 million members. There is about 146 credit unions with about 300 billion, each of which these 146 credit unions have more than $1 billion in assets each. And we put them all together as $300 billion worth of assets. So the credit union industry has, a lot of credit unions are very large institutions. So we don't seek to apply CRA to the smaller community development credit unions or the credit unions that are called low-income credit unions that are devoted to serving poor people. We are interested in applying CRA to mainstream credit unions that are rather large institutions. And actually, when you look at their data, and we've done this for many years, you actually see that they have a lower percentage of loans to minorities, to women, to low and moderate income people than banks. And another really interesting experiment is that there is CRA for credit unions in the state of Massachusetts. And this has been going on for several years, and the CRA exams look remarkably similar to the CRA exams for banks. And there are credit unions in Massachusetts that have a state charter. That means that they are chartered by the state of Massachusetts and they have CRA exams. Then there are credit unions that operate in Massachusetts that have a federal charter. They're chartered by the federal government. Ironically, it's the credit unions that have a federal charter that are not covered by CRA. So you have, and you compare the performance of the state chartered credit unions versus the federal chartered credit unions, and we find that the CRA covered credit unions in Massachusetts outperform the credit unions that don't have CRA responsibilities when you look at their data in terms of serving low and moderate income people, minorities, and women. So the fact that CRA for credit unions has been tried for several years in the state that is the headquarters, that's where the chairman of the House Financial Services Committee resides from. He has seen that experience, Chairman Barney Frank. And Chairman Barney Frank has said it is time for CRA for mainstream credit unions, and we agree. CRA is a win-win. It is not onerous. It has promoted, banks have seen that it has promoted safe and sound lending and helped them gain markets. And we believe for large credit unions it would similarly be beneficial. And applying CRA to credit unions is part of HR 1479, as is applying CRA to insurance companies, securities firms, and remember mortgage companies we talked about, that mortgage companies making a lot of the irresponsible and risky high-cost loans. And remember who financed mortgage companies: Wall Street investment banks, hedge funds, would have now an obligation, if the bill became law, to serve communities consistent with safety and soundness. Any other questions, Ada?
No, I think we're good.
I have one. Creation of the database on the loan, it will include the collect data from how we are facing a phenomenon that is slightly we're buying homes now, but low-income people get a loan once who's getting, okay, 3 or 4 or 5 loans for $150,000 and buying. In other words, is there any data collected about who is buying now? If the minorities are being denied the loan buy of their own finance, and people who are buying now are buying twice or 3 times what these people are losing the money.
Yes, let me just say real quickly, and you know, we can see at the end if there's more time to, but actually the answer is straightforward. The question is data on the dollar amounts of the loans and who are receiving the loans. The gentleman saw in his area that there was a rapid increase in the loan amounts. Some of that could be because of inflated appraisals and other unsavory practices. But let me say the Home Mortgage Disclosure Act data helps you answer those questions year after year. Is the dollar amount of the loan, the race, gender, and income level of the borrower receiving the loan. So you can track, you know, whether low-income people, middle-income people, or upper-income people in your community are receiving loans, or whether you can track it also by race. You can actually use the Home Mortgage Disclosure Act to look at trends like disinvestment. Are much fewer people receiving loans? The opposite process of disinvestment is gentrification. Is it, you know, primarily upper-income people receiving loans and low-income people being priced out of the market? Both extremes, disinvestment versus gentrification, call for different policy responses, you know, clearly. So the data helps you craft a policy intervention. Let me continue a little bit. Let me also say we talked about the merger application process. So what the other thing that the CRA Modernization Act would do would be to make the merger application process more robust. Now, currently, when a bank wants to acquire a insurance company or a securities firm or a mortgage company, there's not even any requirement to submit an application to have a public comment period. Several years ago, when Citibank acquired the Associates, that was a huge controversy, because Citibank, a regular bank, it was acquiring the Associates, which was a mortgage company, which had a really controversial record of making abusive loans. So people wanted an application process, a public comment process, and there was none, because the bank was acquiring the mortgage company. Let's end this anachronism and have a merger application process when a bank, doesn't matter if a bank's acquiring a bank or if a bank's acquiring a mortgage company or other financial institution. There are oftentimes serious concerns about fair lending and CRA performance. So let's have a public comment period and an application requirement for all types of mergers. And CRA Modernization Act would require that. Another part of the, next slide, public meetings and hearings. Another very important part of the merger application process is a hearing process. For huge mergers, people want to be able to testify and be witnesses. During the last 8 years, there were very few public hearings convened by the Federal Reserve Board and other regulatory agencies. You can really understand the gravity of the situation more if you're a regulatory agency and you hold a public hearing and hundreds of people show up, than if you just receive letters and comments, via letters. And you can actually have a more robust conversation if there's a public hearing. So the CRA Modernization Act would require public hearings in areas that would be significantly impacted. And also the CRA Modernization Act would require kind of smaller meetings between anyone commenting on a merger application, a bank, and the federal agency official. This used to be actually the procedure of the Office of Thrift Supervision. It was a good procedure. It was a smaller meeting as opposed to a public hearing, but still you can get a lot more across in a hearing, in a meeting, and have a lot more back and forth than just submitting letters. And so we want to reinstitute this requirement for at least a meeting among some stakeholders if you're not going to have a public hearing in all cases. So we go to the next slide, repeal recent weakening of CRA. Remember I talked about for small banks having exams once every 4 or 5 years? Well, the CRA Modernization Act would put that back on a 2-year schedule. And we think that would be very instrumental in increasing the lending done by small banks. If the examiner comes once every 2 years, you're going to be doing more lending than if the examiner comes once or twice in a decade. Also, we talked about how the mid-sized banks no longer have to report small business loan data. The CRA Modernization Act would reinstitute the data reporting requirement for small business loans, which actually is a very important line of business for the mid-sized banks. Next slide, it says CRA Ratings Enhanced. This is actually strengthening CRAs applied to banks. This is important because right now you have 4 ratings. You have outstanding, satisfactory, needs to improve, and substantial noncompliance. And remember we talked about grade inflation. Well, if you're still going to have 98% or 99% of your banks passing, wouldn't it be nice to have some more meaning in the ratings? You can pass with a B- or a C as well as passing with an A or a B. So if you add some more ratings, a high satisfactory and a low satisfactory, for example, you would have more meaning in the ratings, and you would know that low satisfactory is a possible final grade. Low satisfactory is actually a possible grade for an exam in one state or one geographical area. We think it would actually have more meaning if you also made that a final grade, a possibility for the final overall grade as well. And we also do something, the CRA Modernization Act also does something I think is very innovative. We're going to have fewer bank mergers in the next few years because the banks have gotten very, very big. You may remember that there were some emergency merger approvals that were unprecedented. For example, JP Morgan Chase took over Washington Mutual, and Washington Mutual had failed, and there was no opportunity for public comment. Bank of America is now so big. Bank of America is now so big that it owns about 10% of the deposits in the country. And by law, it cannot acquire other institutions and increase its share of deposits. So you're not going to see Bank of America merging unless there's a change in the law. So if there's going to be fewer bank mergers in the next few years, what other mechanisms can we do to make sure that the CRA remains rigorously enforced? Well, particularly for the large banks cover several states. And a large bank, it might get a passing rating overall, but may not really do that well in a particular state. So what the CRA Modernization Act says is if you have a low satisfactory or worse, or worse rating in any state, you have to submit a public improvement plan to the regulator, how you're going to improve your grade. And anybody from the general public can comment on the CRA improvement plan. So this is a mechanism that's supposed to make sure that CRA enforcement remains, even if you're going to have slower mergers. And also, what's going to happen is this idea of a CRA improvement plan, we think is going to be very important for smaller cities and rural areas, non-metropolitan areas, because oftentimes we'll see some good performance in Philadelphia or New York or the big cities, but we'll see less lending in the smaller cities or the non-metropolitan areas. And if bank gets a low rating in the non-metropolitan areas or the smaller cities, then the CRA improvement plan should help to make sure that bank performance is more uniform. I understand that I have a question.
Yeah. It was stated that the regulatory
The question was, who regulated AIG? AIG failed spectacularly, as you know. AIG, and the question is, who finances the regulatory agencies? AIG is a very complex institution. It's an insurance company. It actually operated a savings and loan. The insurance company, let's suffice it to say, was very poorly regulated. Can you imagine an insurance company that operates across the world that's regulated by a state regulatory agency? That's probably a case where regulation has not kept up with the reality of these complex and huge financial institutions. Now, the savings and loan was regulated by the Office of Thrift Supervision. And the Office of Thrift Supervision did not adequately enforce the laws. What's interesting, though, is the Office of Thrift Supervision did finally fine, there's about a $150 million fine to the savings and loan, to the AIG savings and loan. And guess what? The savings and loan was found by the Office of Thrift Supervision to be doing abusive lending. It was like the time period of 2003 to 2006. And the OTS fine came a little too late, 2007. Now, regulatory enforcement is not supposed to wax and wane depending who's in the White House. But believe it or not, who's in the White House, whether it's a Democrat or a Republican, who cares, does make a difference. And there was a difference in regulatory enforcement during the two previous administrations. In the last 8 years, it was rather lax. Now, who finances the regulatory agencies? Believe it or not, and this is something that may be changed, is you have 4 federal regulators, and guess who pays their bills? The banks, who are regulated. And the banks may say, okay, if you give us a really tough exam, we're going to go take our business to the other regulatory agency. That is known as picking your regulator or regulatory arbitrage. And this type of abuse, right now, next week, the Obama administration is supposed to release its recommendations for regulatory restructuring. And no matter what structure we may have in future years, it is critical that this regulatory arbitrage is addressed.
Well, yeah, David follows up with this
How can you make sure, even if 1479 was to pass, that the federal regulatory agencies will be doing their job and that there will be sufficient oversight of the federal regulatory agencies? That is a very tough question to answer. Let's suppose for a moment that all the consumer and community enforcement is put into an agency called the Consumer Product Safety Commission. This is a proposal by Harvard law professor Elizabeth Warren, an agency that's dedicated to care about whether consumers are being served, to make sure there's no discrimination, and to make sure the consumers are being served safely and soundly. Now, some hope that this agency would more vigorously enforce consumer protection law. Now, that may or may not be the case. And it may very well be the case, but it is more likely to be the case if you have a very engaged public that comments regularly on CRA exams. Now, when I make that comment, some people say, why should the onus be on the general public? Think of CRA as three legs of a tool, of a stool. One leg is the banks, one leg is the regulators, one leg is the community organizations. If the community organizations are not there, and it's only the regulator and the banks talking to each other on the CRA exam process, and they're not being watched by the general public, well, you might find sloppy CRA exams, you might find sloppy enforcement. So whether it's community organizations or Congress, there has to be an active public looking at the CRA exam and merger application process. And the genius of CRA exam, of the CRA statute is it's a legal mechanism that requires that there is a process that the public can be actively engaged. And it is NCRC's mission to encourage as many people in the public to be actively engaged. And in response to the question, isn't this an onus on the general public? To some extent, maybe it is an onus, but it is also very, very, very clear that the more active public you have, the more effective this law is, because this law is a transparency law, and the transparency law will work better if people are more engaged in the democratic process.
Yeah, I have a question.
Yep, and it's 3:30 now.
And would you get a consensus from people?
Well, I think I can finish. Let me talk for about 5 more minutes, and then I think we can entertain a few more questions. So I'm willing to extend it for, at least 10 more minutes.
If that's okay with the people in the room and also the people online. So.
Okay.
Yeah.
Well, getting back to the presentation, when CRA ratings are downgraded. Right now, CRA ratings can be downgraded for illegal and abusive lending activities. And if we had CRA applied broadly throughout the financial industry, this concept of when CRA ratings could be downgraded would apply to the other financial institutions. Securitizing bad loans, like buying bad, risky loans and then selling them to investors, that would also be explicitly penalized on CRA exams. So we go to the next slide. I may not even need 5 more minutes, actually, because I actually took the opportunity about the CRA and credit union question to talk about that HR 1479 would apply CRA to a variety of non-bank financial institutions, which would include independent mortgage companies, securities firms, insurance companies, mainstream credit unions, all affiliates of bank holding companies. The CRA exams would be similar, but would be tailored to the capacities of these different financial institutions. Think of CRA exams that are different right now for different types of banks, for banks of different sizes. Well, the same concept would apply, that clearly different financial institutions would have different CRA exams. And the next slide says HMDA-like data, Home Mortgage Disclosure Act data, that has been so successful in helping to increase responsible lending to women, minorities, and low and moderate income people. Although the HMDA data does have to be enhanced, to include loan terms and conditions. HR 1479 would basically institute a HMDA-like requirement for insurance companies and securities firms and private mortgage insurers. The next slide talks about CRA enforcement and sanctions. We talked about before when a bank wants to acquire a non-bank financial institution, the bank would now be required to submit a merger application. But what happens if two insurance companies seek to merge? Well, the CRA Modernization Act would require a public comment period, and comments could be taken on the CRA performance of the insurance companies, for example. Now, if a mortgage company fails its CRA exam, let's say that, historically there hasn't been a whole lot of mergers just between mortgage companies and mortgage companies. It's usually a bank buying a mortgage company. So if a mortgage company is not really going to merge or acquire anytime soon, what would be the sanction? Well, one thing we thought of is mortgage companies often sell their loans to investors. And if the mortgage companies failed its CRA exam and then did not submit an improvement plan that was satisfactory, then the mortgage company could not sell its loans to Fannie Mae or Freddie Mac. Now, what we think this basically would do would basically, the mortgage company says, I better submit an improvement plan that will be approved by my regulatory agency. So it's basically a mechanism to make sure that mortgage companies will take serious steps to improve their CRA performance. And remember, the improvement plans are open for public comment before the regulatory agency approves the improvement plan. And the regulatory agency would consider the public comments and could say to the mortgage company, you have to change this or change that about your improvement plan. Insurance companies, don't make loans directly, but the sanction would be similar for insurance companies. If the insurance company failed its CRA exam and did not enact a satisfactory improvement plan, then loans that were insured by the insurance company could not be sold to Fannie Mae or Freddie Mac. So that would be a possible, those are some of the additional sanctions in the CRA modernization bill. And basically the last slide answered the question about oversight. Once a year, this bill would require the Senate Banking Committee and the House Financial Services Committee to hold a hearing about whether the CRA Modernization Act, how well it's being enforced, and and consider revising the law if there are aspects of the law that are not being enforced adequately. Now, there's no guarantees in this business. If Congress is not serious in overseeing the federal, if Congress is not serious in overseeing the federal agencies, then there is a possibility the federal agencies can do a lackluster job enforcing the law. So you have to have an engaged Congress, and ultimately the only way to have an engaged Congress is to have an engaged public, and that is NCRC's mission. And I will take questions.
Okay. Well, actually. Why we need to support and promote NCRC. Being our eyes over the really, thank you for that comment.
Question. Well, first of all, we got some wonderful compliments, and I want to thank everybody for the wonderful compliments.
And mention going to our website again.
And since there is such goodwill that has been generated by this seminar, I will leave you with an ask. And the ask that I will leave you with is look at our website, ncrc.org, and see if your member of Congress has co-sponsored HR 1479 or the Community Reinvestment Modernization Act of 2009. And if your member of Congress has not yet co-sponsored the bill, please call your member of Congress and say it is very, very important to co-sponsor this important bill. because the more co-sponsors we have, the more likely that this bill will move through the House of Representatives and then go to the Senate. And then there was another question about a national media campaign, where right now we are engaged in a national campaign to promote CRA modernization. And a national media campaign is a very important component of this campaign. And if anyone has insights about how to get the story across to the media, we welcome your insights. And also if you have local media outlets, a radio station, a TV station, that would be willing to carry the news about CRA modernization, please let us know. And I should also mention on June 11th, and on Thursday, some of you may know on this seminar, we are having a National Day of Action in 50 communities across the country. And we are going to be having a variety of events, whether it's a rally, whether it's a town hall meeting, that will discuss how to end the foreclosure crisis and what are the solutions. And we think one very important solution is passing the CRA modernization bill. So if you want to know whether there's an event in your community, again, our website can,
And I'm sharing it right now, the website.
and you can go to our website, ncrc.org, to see if there's an event near you on the National Day of Action on this Thursday.
Okay, and it's open on their screen.
Okay, our website is on your screen.
So they can just
Click on the left-hand side on the Day of Action. Or there's also, if you just go to the home page, there's also just a list of events.
Okay.
If you go to ncrc.org, and also maybe you want to see them, show them the left-hand, show them the left-hand side, but also show them the right-hand side where the CRA modernization toolkit is.
Okay.
Go to the right-hand side, John. There you are. See CRA, what does it say? CRA Modernization Campaign, 50 by 6/11. That means we want 50 co-sponsors by June 11th, and we're now on 37. 38. So we need, what's my math? 12 more. 12 more it is now Tuesday, so 12 more in about a day and a half. So that's a tall order, so we need your help.
Okay, great.
So, any last questions before we adjourn? Oh, I've been reminded there is an evaluation form. Please fill it out. Please give NCRC and Josh Silver outstanding marks, or at least satisfactory. But be honest. Be honest and be transparent. That's the most important thing that I'll say. And that's it. Thank you so much.